Hey, Renter Retires, it's Adam Schroeder here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Renter Retirement. And we're going to be talking about something that's unique to me. We always talk about how capital is the most limiting factor for all investors. So we have Ryan with us today from Release, and we're going to talk about ways that investors can access capital themselves. So Ryan, thanks for joining us.
Yeah, thanks for having me, guys. Appreciate you keeping me on the show here.
So tell us a little bit about kind of your real estate background, and then also just in general, what this product is that we're talking about today with Release.
Yeah, it's funny, how we got into this. So I was originally one of those tech nerds out in California. We were building tech companies out there and had a couple decent exits along the way. And ultimately left California as part of that mass exodus, came down to Texas. I'm down in Austin, Texas now. But as luck would have it, while I was back there, I was actually investing in multifamily properties myself. So was always a passion, loved the real estate space, paid for it, through obviously our tech ventures and all of that. But what was interesting is that, I wanted to go scale my own portfolio, right? Like really grow this and start to scale it up. And so did exactly what you'd expect, started to chat with some of my friends who had, built out some sizable portfolios, right? Some of them, hundreds of units, others even had thousands of units. And I just asked them, hey, what are some of the limiting factors as you go to scale your portfolio? What will I run into, right, as I try to scale it myself? And time again, the number one issue was capital, right? Working capital in particular for this, subset of group. They always needed money for renovations, or they needed, cash to go do a down payment to go buy their next rental property. Sure, they could get long-term debt and, whether the terms were right and all of that, you could sort out. But they always had this challenge with getting working capital to really scale. And so I set out and said, well, how could we solve that, right? And so, essentially, we didn't find a good solution, right? Of course, you could go raise private capital and, you could do some of these other things. Hard money is an option, and pros and cons to all of it, right? I mean, certainly they all have their place in the market. But we actually saw a model like Release in a totally different asset class. And so Release provides working capital really to rental property investors, but we do it in a unique way. We do it through revenue-based financing. And so we look at your existing portfolio of properties, we look at the free cash flow there, and we essentially allow you to trade a portion of your future rental income in exchange for cash up front. So what's critical for the borrowers here is that it does not add debt, right? So that's like a huge benefit as a borrower. We also don't take any of your equity there, right? You're essentially trading just a portion of that future rental income in exchange for cash up front, generally on a short-term duration, anywhere typically between 12 and 24 months in duration. We have flexibility, but that's generally what it looks like.
Yeah, this is really exciting stuff. Thank you for breaking that down, Ryan, and sharing your personal history with real estate. It's interesting the number of people that are in tech in different industries that put their money into real estate, and they're also interested in real estate for like building wealth, for tax benefits, and for holding long term. We have the privilege of working with people in a having a diverse background, and many of them are successful business owners. And it's just interesting to me how money migrates to real estate to hold and build wealth over time.
Oh, yeah, it's spot on, Zach, right? I mean, certainly we were playing the venture life out there, and look, I mean, it's pros and cons certainly to that, and it's interesting, and you can build vast amounts of wealth that way, but, it's rocket ship up, rocket ship down, right? And so, if you want to have, stable assets, you want to build wealth over time, real estate is hard to beat.
And I'm sorry you have to live next to Adam here in Austin.
Oh, yeah.
It's a great place. But so for everyone, this is going to be a 3-part series specifically centered around how to access other resources that you are likely unfamiliar with. As Adam mentioned in the beginning, and I say all the time, and Ryan certainly explained in his own interview with very high-level investors, capital is always the most limiting resource to scale that never stops, guys, and it gets more challenging over time. And so the more creative you can be to utilize things like this to be able to scale your portfolio, the more successful you're ultimately going to be, because real estate scalability is the name of the game, right? And just saving up your hard-earned down payment to use on another property is the slowest way to scale. And so this is the first part of a 3-part series of looking at creative finance ways, especially, and this is going to be released to our Academy members, specifically access to how to go through and scale their portfolios. Of course, we cover things like using HELOCs, creative financing options like our credit unions where you can put as little as 5% down on new construction properties. We talk about ways that you can invest through your retirement vehicle, through a solo 401k or self-directed IRA. But there's a lot of different things you can do. We talk about raising money from other people, raising private capital and partnerships. But specifically what we're doing in this 3-part series is talking about creative options that you have likely not heard of. So this one, we decided to bring Ryan on with release first because this is something I've personally done. And I have personal experience with you guys. And it was probably, when I first heard about this, this is not something I was familiar with, and is very exciting to me because basically, just to reiterate what you're saying, Ryan, what you guys do is you take future anticipated cash flow and you give that to people up front. It's like you're getting your cash flow up front in a loan that's not secured. It's not a loan that goes on your credit. It's not a loan that goes against a property. It's an unsecured loan that you get for future revenue. And I'm happy to be transparent and share. I don't know if you have numbers of what I did with you guys, but I think I was able to access like between $300,000 to $400,000 that I paid back on an 18-month period where I'm almost done with that payment back. To you guys, where I was able to take that money and then buy a ton more real estate, which was advantageous for me because for us, it was buying as much real estate as we can so we can do cost segregation and use depreciation. So it's like scrambling all these different resources. But let's go through how this actually logistically works. And Adam, put on the link, if you would, please, for anyone that wants to connect with Ryan. If they're just like, hey, I've heard enough, like, let me find out what this is. But basically, this is, you have to have an existing portfolio that is positively cash flowing, likely having, maybe this isn't a situation for someone that has one single family house. I mean, I'll let you explain further, Ryan. We spend a lot of time going through different scenarios. Yeah. But if you have even a small portfolio of a handful of houses, single family, small multi, whatever, and they're positively cash flowing, this may be a situation where you can tap into a portion of that future anticipated cash flow to get that day one to then grow your portfolio. And we'll go through a specific scenario. But did I get that all right, Ryan, or anything you want to add to that?
Zach, you nailed it. You're hired, man. You could join the team. Yeah, it's one out there, right? You're spot on. So look, for us, we can work with folks with much larger portfolios. We do that all day long, but also we can work with some of the, call it the smaller investors who are just getting their portfolio up and running. Really probably 3+ units. They can be single family rentals, a portfolio of those. They could be multifamily, doesn't really matter. You could go smaller. You could do 1 or 2, but practically speaking, you're generally not cash flowing enough to really to matter much or to get you enough funding to matter much for your own investments. Probably 3+ is kind of the sweet spot.
3+, okay.
So let's say I've got 4 properties, cash flowing $250 a month. This is relatively conservative. So I've got $12,000 a year coming in cash flow positive from these properties. With something like that, what is a realistic number of what I could borrow or get from you? And then what is my risk on this debt?
Yeah. So look, this is sort of a rough way to do it, but I think the easiest way to look at it, if you're, considering it for your own portfolio, is to look at that annual free cash flow number, right? What you just mentioned there, which is, $12,000, I think in this example. And that's roughly the amount that we could get you up front, right? Give or take a bit, maybe 25% or so. So could we get you $12K, $15K, something like that? Sure. Could we get you $100K or $200K? Probably not on that, right? So it's order of magnitude, call it maybe 1x, 1.25x. Your annual free cash flow is likely what we can get you. And so, risk to you, that was your second question. Look, borrowing always has some sort of risk, right? I mean, I think, the downsides to this, right? I would be remiss if I didn't say that. The downsides, I think, to this type of funding are the amount of cash that you can get, right? I mean, we just mentioned it here where if you have a relatively small portfolio, you probably just can't get that much cash from us. But 15, 20, 25, 50K maybe matters in your situation, right? And so, it might help you get to the next step. And as you add more properties, we can get you more funding, right? And so you continue sort of this snowball effect and can accelerate even faster. Zach mentioned earlier, we do not encumber your property. So we're not taking a second position in there. We're not putting a lien on your property, which is, critical for you there. We're not taking any of your equity either, right? We just care about your free cash flow, and you're trading a portion of that free cash flow. Now, of course, to repay us, you're going to have less cash flow that you otherwise would have maybe taken and, held on to and used for whatever you use it for, right? Your personal expenses, what have you, right? You have to repay us there. So that's something to think about. Though we bake that in when we offer the funding. We know that you need padding in there. You need money to pay your mortgage, rainy day money, all that stuff. So we're not taking all of your cash. That's for sure.
The biggest question we always get after someone has kind of reached that threshold of like, all right, they get into the game, they get a handful of rentals, whatever the case is, and they kind of tap out and they're like, man, I don't have any more money to use as down payments. We've explored a HELOC, retirement account.
Yep.
We've partnered with, mom and dad, whatever the case is, or brother or sister. They have looked at, lines of credit, things like this, and different things. But anyways, this is just one piece of the puzzle, you guys. But the common question we get is like, how do I scale? It's really the same question we get time and time again, and the same answer. You need to be creative, and you need to look at different resources you have. If you have an existing portfolio, this is a way that you can access that cash flow. I would argue that most people, when you're in the scalability phase, we talk about the different phases of building wealth and rental real estate. The first phase is scalability and diversification. The next phase is more of like stabilization and optimization of your portfolio. And then the third stage, if you get to this point, or if this even makes sense for you, is almost like almost scaling down and consolidation and deleveraging towards the end of, like, this is more when you're towards the end of life. I personally will never be in a deleveraged position because I will die with debt, right? And never have free and clear properties because it's advantageous for us to have debt. Anyways, without getting sidetracked, the most common question is, how do I scale? And this is one piece of the puzzle, you guys. If you can access an extra 10K, or 20K or whatever the case is, then this could be, that could be a down payment or half a down payment on another property. If you have a larger portfolio, it could be more. Maybe this doesn't make sense for you right now, but it is something to consider in the future. This is something I've personally done with these guys, and it took me a couple of minutes to wrap my head around it. But I'm like, yeah, we're not living off of this cash flow. And that was really the point I was trying to make without rambling on too much, is that most people in the scalability phase, you're not living off of cash flow. Of course, you need to have reserves, and you want to make sure that your property is positive cash flow to cover your mortgage and your expenses. But, a few $100 a month per property, like, most people are not in the position when they're scaling to the cash flow is not making a dent, and they're not living off of it. Some people are. Maybe if you are, then that doesn't make sense for you. But you just think about all the different resources you can scale. But Ryan, I guess what does like the qualification process look like? Do you pull people's credit? Does this show up on their credit when they go to get a mortgage on another lender? Because that's a big obstacle with a lot of people, right? You take out a HELOC, you do some of these other things that could inhibit your credit ability from a DTI standpoint. We're not talking about lowering credit, because it's, when you run credit, it's not going to lower it that much. But we're talking about like your DTI. So does this show up on credit reports?
Does
and
not.
What does the qualification look like? What is the process?
Yeah, it does not. So it doesn't show up on credit. There's no personal guarantee on there. So very advantageous to the borrowers on that side. Look, we move fast. So the funding process is very, very quick. We, typically we'll give you a quote with just, we need some basic information about your portfolio, obviously, right? We'll need to know gross rental incomes, your, what type of mortgages you have on the property, all of that good stuff. But pretty quickly, we can get you a quote. And so we'll let you know, hey, here's how much funding we think we can get you. Here's the term, right? Here, here's what it's going to cost you, right? And it's in, basic terms there, very easy to understand. And from there, if it looks good, we'll do the full underwriting. But the full underwriting is much less cumbersome than, trying to get a mortgage or a traditional line of credit. We'll look at things like your, trailing income statements, your rent rolls, those types of details. But start to finish, on a great day, we can fund you in, call it 3 business days. Literally, from the time we first talk to you to the time that the money hits your account, could hit you in 3 business days. Candidly, we're a little backed up at the moment, but still it's relative. We're funding in a week, maybe a week and a half, right? So it's very fast, quick turnaround.
So it would be safe to assume that you need to have good financials on your property, right? You can't go turn in well, maybe you could, but I mean, an Excel sheet saying, I guess if it's verifiable, but obviously having a property management team that has good books to show you is preferable in this case, right?
It speeds it up, certainly, right? So if you keep good books, it speeds everything up. If the books are, clumsy and all of that, of course, our underwriting team is going to dive in and look at all this stuff. They're going to verify it. I mean, this is we're not just taking your word for it, but clean books always makes it smoother.
Let me just clarify what you stated earlier. Maybe I missed this. Do you run credit for this or no?
We don't need to on this. We care deeply about the performance of your portfolio, right? That's really a key piece for us. We're looking at that. Of course, we look at you as an operator and, we're looking at those details, but we don't need to pull your credit. We don't need to run credit. None of that.
So no credit. This is, and maybe people miss this is basically a non-recourse loan because there's no personal guarantee. And I have a hard time even calling it a loan. I guess it is a loan. It's a loan on future cash flow. But it's not secured against real estate. It doesn't touch your credit, and it is and it's unsecured. There's no personal guarantee with it. That's really important, I think, to think about because it is hard to get debt in those three categories. You know what I mean? Most all debt is secured, at least when it's tied to real estate, secured and personally guaranteed.
Yeah, that's right. So it is secured in a fashion. So I just want to be clear on that it's not completely unsecured, but it's not secured in the traditional sense, right? So certainly, as you mentioned, most debt would be secured by the property itself. There's a personal guarantee, something like that that's securing it. For us, we're actually typically doing the deal with the underlying entity that owns the property, right? So you have a scenario where somebody might own whatever, a 5-unit building or something. It's in an LLC, a 10-unit property, what have you. What we're doing is we're securing against the free cash flow on that underlying entity. And so it's not that there's no teeth in it. It's just that we're not encumbering the property itself. So we're not taking a second position lien. We're not adding debt to your property there. But we do have cash flow rights in the event of a very rare event of a default. Then we would have cash flow rights against that underlying entity that owns the property. So there's recourse in there. Of course, there's bad actor clauses. You can't take the money and run and not repay. All of those things are in there. But the reality is we're looking at the performance of your portfolio. If it's free cash flowing, we're adding padding in there. We're trying to predict how well it will perform over the next 12 months, for example, if that's the term. You get it right most of the time.
So this is, and the interest rate will vary based on where prime is at, of course, like anything, right?
Yep.
I mean, but one thing that I know was important to me is I believe, correct me if I'm wrong, but thinking back, I don't believe I paid points for closing. I think it was
no points.
Basically no points. So that's also a big thing too, right? With hard money, a lot of times when you're closing loans, there's lender fees or points, a percentage applied. I think the interest rate that we were paying was a fixed rate that was over the term of the loan.
Yep.
So it's basically like my payment every month. I'm principal and the interest is paid into that over whatever the term of the loan is. Is that right?
Yeah. So it's a great way to think about it. So in this case, it's not technically a loan, it's revenue-based financing. And so what we're doing is it actually floats a bit. The repayment floats a bit. Based on your free cash flow on a given, monthly basis. We can help you smooth that out over time. But essentially what you're doing is you're paying a discount rate. So we look at your future cash flow. We're buying that at an upfront discount, right? Which would really be the equivalent, really of an interest rate. If you're thinking about it from a traditional loan standpoint, we're buying it at an upfront discount. And so if we wire you $100K today and our discount rate is whatever it may be, 12%, for example, I'm just purely throwing out an example here, you would repay $112K over the course of that tenor, which might be let's call it 12 months. So a perfect example, we wire you $100K today. Let's say it's a 12% discount rate. You would repay us $112K over that 12 months. And so your cost in absolute terms of borrowing that capital would be $12K, right? There are no additional origination fees, closing costs, no points, right, that you're paying down, no appraisal fees, no legal doc fee, none of that stuff. It's very easy to understand. This is what I borrow. This is the absolute dollar of what I repay. That's it. Simple to understand.
And you said the typical repayments are about a year, or is it does the length vary, or
Yeah,
how
the
much
length can
how much forward-looking cash flow can I access? Is it just 1 year? Is it 2, 3?
Yeah, you could go up to 2 really on this. So the longest we'll really go typically is 24 months. As you get beyond that, it starts to act a lot more like long-term debt. It changes the way you underwrite and think about this. But what we do, practically speaking, is a lot of folks will come to us, they'll borrow for a year, for example. They'll repay it, and then they'll just re-up and do it again for another year. And so really, you could do this to infinity if you want to, right? We just do it in smaller bursts because that changes our own interest rate risk, your risk, all of that goes into it. So we fund on a shorter term basis. Great question.
What happens if the properties, are you monitoring performance? I don't think I've ever had to turn in, maybe I have, but has there...
What we can do, so we sync with your bank accounts, right? And so we can see your cash balances, right, over time. And so we can basically understand your ability to repay on any given basis.
What happens though if the property, like you have an eviction, tenant moves out? Is there any? If someone's paying you still, even though the property is, let's say, vacant over the course of the 2-year term, if you're pulling a full 2 years, which I don't even remember that being an option. You can actually pull 2 years forward. That makes that more powerful than just 1 year. Yep. So that previous example where we had that $12K of annual income, that could be $24,000 over 2 years.
Yeah, you could raise it. That's right.
The time that and this is hard for people to conceptualize, but when you look at like an IRR and a time value associated with money, that just has such an impact on, like, the interest rates are kind of irrelevant in that point because you have money today that you can invest. Arguably to do better than 12% or whatever. I know we're arbitrarily saying that number, but just for example purposes, like, that's a little bit of arbitrage, right? I would rather have money today that I can invest and earn an income on, and guess what? Leverage, and then you have tax benefits and get 30+% return on investment. That's obviously why I did this. It makes sense for me. But just to be clear, my initial question was, if the property's not cash flowing, and what happens then? Is there any recourse with that, or?
Yeah, you can. So you can certainly adjust the payment downward, right? So you could certainly pay less on a given month, right? And so that is the value to a borrower of revenue-based financing. You can, the payments can ebb and flow, right? We'll put a max on it. We're not going to, go take all your cash flow, right? But it can ebb and flow. So if you have vacancies in there that are really materially affecting your ability to repay, then you can certainly pay lower amounts that month until you re-rent that out, and then you can resume your payments. And so when we model this out and we're looking at your properties, we're assessing all of that risk, right? Our risk is actually higher on smaller portfolios, right? Because you have vacancy risk in there, where if you have 5 units and 1 or 2 tenants go, that's actually higher risk for us when we're funding you. If you're somebody with 80 units and a handful of tenants go, probably doesn't matter, right? Doesn't really impact your ability to repay. So it's quite different.
I want to go through my specific scenario and just talk about, like, why this made sense for me. And this may resonate with some people. Now, I'm going to really talk about, like, doing the accelerated depreciation here. Even if you're not doing that, I think this still makes sense as a way for you to scale, as long as you have reserves. That's always a thing, which is important to know. But this would be a huge way to scale. And of course, if you aren't qualifying for RE Pro, we've talked about this 1,000 times, but maybe doing something like the short-term loophole would be interesting to look at as well. That's a side note. Can you guys do short-term, or is this only annual leases, long-term?
Typically we'll do long-term on this. Boy, we get asked that a lot on these short-term rentals. I think we'll look at those portfolios. My guess is we get into that pretty soon, but today it's long-term and really our bread and butter.
Certainly, and I understand that. I can get that. It's more trackable, right, and more predictable. But what about someone that has 3 years of pretty much track records in short-term rental where they can show consistently?
We'll consider it all, right? So Zach, as you know, we're direct, right? So we have quite a bit of flexibility. We have flexibility in how we structure repayments. We have flexibility in the asset class that we underwrite and fund. Our true bread and butter, though, tends to be multifamily or smaller single-family portfolios of long-term rentals. That's where our speed comes from. That's where our underwriting skills come from. Our models are built that way. And so we can move fast and fund. Can we do other deals? Absolutely. We can do other deals. So bring them to us. We're happy to look at them. But if you have, something in our immediate strike zone, we're doing those all day long. and we do it fast.
Yeah, you guys were creative with me. I mean, even the deals that I brought to you, there was some commercial retail in there. I mean, you were like, this is outside of our box, but we figured it out, right? So we could just answer the questions and go from there. And yeah, we have one of our short-term rentals did over $500,000 last year. So that's something I'm going to be contacting about this next go round, but free up some capital. So just in my own situation, for everyone listening, this is kind of where it made sense for me. So I always like going through the numbers to really conceptualize this, but I think my loan was $350,000 that I was able to advance on cash flow, and I believe I just did just 1 year of advanced cash flow, at least at the point in time. And I believe my term was an 18-month term. I could have extended that longer, but that's just anyways what I chose to do. And we're almost done with that. I think we're in our last 3 months of that payment. So I took that $350,000 of advanced cash flow, which I would have received on my properties over a year anyways. And I used that and used leverage to buy. And I did this last year because I received it during last calendar year. Actually, it's 2022 now that we're in 2022. Yeah. But received that money and I leveraged it. And I bought $1,750,000 roughly of additional properties by advancing that cash flow from my properties, because we don't actually need the cash flow right now to live off of. This was not our entire portfolio, by the way. We did with this on a portion of our portfolio. So this allowed me to buy, $1.75 million of additional real estate that we did accelerated depreciation on, which averaged about 35% for us on what our cost seg studies came back at. I had one of our properties come back at 39%. Some less. So I think we averaged about 300 or 35%. And that was when we had 100% bonus depreciation. So that was able to allow us to take a loss of $612,000 by doing that. Just the tax savings alone by buying that additional real estate is phenomenal. That alone covers the interest and like the whole idea of just doing this in general. But then the bigger concept that I like to look at is that if I had $1.75 million of real estate that appreciates now that I just bought by doing this, that I wouldn't have otherwise done because I wouldn't have had the capital, that appreciates at an average 5% per year, which we're doing better than that. That's $90,000 of appreciation that we can add to this. Those properties are positively cash flowing, which I'm actually using as, also to pay back, right? I mean, the cash flow on the current properties are paying back the loan anyways on other properties we have, but also the new ones that I bought, you could use that to also pay back some of those properties. So when you look at that, over $600,000 of tax deductions for that year, over $90,000 and even though we did much more than that of appreciation, and that's just the tax benefits based on accelerated depreciation, not all the other tax benefits you get. Hopefully this is getting some wheels turning for people about how you can use this to scale, right? This is what this series is about, is how can you access capital creatively and use these strategies to help you scale over time. I just wanted to share my personal story.
Yeah, Zach, that's a great example. And maybe I'll quickly share 3 other examples here just to get the juices flowing for you all. 2 of them are really bread and butter, and the third is maybe a bit more creative. The first one, and guys, don't worry about the scale of these, right? I mean, if you have a smaller portfolio, the same concept applies, right? So forget about the number of units in each of these examples. But, one deal we did, I think this person had something like 90 units across 13 different properties. And so we're able to look at your portfolio as a whole there, right? This is something that's much more challenging if you go to a bank for a portfolio loan or whatever it may be, right? You have to jump through a lot of hoops to cross-collateralize and work that way. But this particular borrower had, call it 90 units across 13 different properties. We funded them against the free cash flow on that existing portfolio. They were able to take that money, use it as a down payment to go take down a 120-unit property, right? They got long-term debt and, some other financing to secure the rest of it, the longer-term piece of it. But they essentially had no money out of pocket to go buy this 120-unit property, which was cash flowing, by the way, right? So they were able to repay us. They got this property they couldn't otherwise get. Win-win situation all around. So that's a great example. And of course, you can do it on a much smaller scale, right? Don't worry about the number of units. The same concept applies. Another example is that we had a borrower, I think 181 units across 5 different properties. They purchased a 6th one that was not yet stabilized, right? So, wasn't yet cash flowing. They needed money, working capital for renovations on that, right? Lots of ways to go and get it. Certainly some are easier than others. But in this case, they borrowed against their existing portfolio, right? They had that cash flow coming. The initial plan and what they had already been doing, by the way, was that they were just waiting until they were getting cash in every month on their existing portfolio, taking that money, renovating a few units at a time, right? Would have taken forever, right, to renovate this building. And so the entire time you're losing money, right? I mean, this is opportunity cost in here. You're actually losing money. So instead, the borrower said, look, I'll borrow this money against my existing portfolio. I'll go use it to renovate this other property much faster, rent it out, right? Classic sort of BRRRR strategy, reposition it. That thing's cash flowing now, and he's a winner, right, across the board. And then the final one I'll leave you with, which I thought was pretty creative. We had another borrower borrow funds against their existing portfolio. They needed, I think, something like $200K to do a rate lock on a larger property that they own that was on floating debt, right? Just like a lot of folks had these, floating, bridge loans on a lot of these larger multifamily properties. This borrower was in a position to get much more favorable long-term debt, but needed around $200K to do this rate lock, right? I mean, it costs money. You have to, put up money to do these rate locks. Did the rate lock, only needed the funds for around 3 or 4 months, I think it was. Ended up saving $30,000 a month in interest with this new debt, right, that they got from that rate lock. So when you start looking at it, say, boy, is the cost of this a 12% discount, a 13, a 14, doesn't matter, right? Like in this case, the savings on the other end were dramatic, right? And where else were you going to get the $200K, right? That would have been a slog. Go raise it from private investor, wherever you get it, totally different.
Yeah, I mean, time value of money, right? I think, Adam, we're going to have to coin this term. I think this is a good tagline to put in this episode, but all the time we talk about like what is the return on equity and how to reinvest your equity. Yeah. And I think this is comparable to that, but only talking about cash flow, right? What is your return on cash flow? And your return when you look at again like IRR and things like that, like being able to reinvest your cash flow sooner gives you an exponentially higher return. People are very familiar with the concept of taking out a HELOC to reinvest that to grow their portfolio. Well, this is a way that you can access future cash flow and reinvest your cash flow sooner on stabilized assets. And we're super excited about it. And hopefully everyone's light bulbs are going off. And I'm sure your email is going to get blown up here, Ryan. So this is exciting stuff. And again, first of a 3-part series of creative ways that you can access capital to scale your portfolio over time.
All right. Well, Ryan, thank you so much for joining us today. Really appreciate your time explaining this concept to people. The website is right there. It's renttoretirement.com/release. That's renttoretirement.com/release. You can fill out that form there. We'll get you in touch with Ryan. Or if you're on a call with us that you booked at renttoretirement.com, just tell your investment strategist there, hey, I'm interested in this, and we will put you in touch with Ryan and his team to start that conversation about getting your return on cash flow, or maybe it's a relock. I don't know, your rental equity line of credit or something like that.
There you go. We'll call that name. Yeah. Awesome, guys. Thanks so much for having me, and keep up the good work. Love it.
Absolutely. Well, thank you so much. And again, renttoretirement.com, you can see our inventory that you can pull some capital or look at your future cash flow there. And as always, if you have any questions that you want us to answer on future episodes, email them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. Really appreciate the time you spent educating yourselves today. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.